Hello, I'm Kirill Kovalenko, Senior Wealth Manager at XSpot Wealth, and welcome to our regular quarterly review. A lot happened in this first quarter, and today we're going to go through main events and discuss them with my colleague, Demetris Theophanides. So what are the important events of the first quarter? To give a complete picture, I will analyze key issues as well as the issue of the banking crisis. Interest rates. The Fed continued to raise interest rates, and now the dollar at the key rate of 5%. All indications are that the Fed will stem interest rate hikes and decide on its next actions after reviewing macroeconomic data on a monthly basis. Inflation. It has continued to decline and is now at 6%, the lowest level since 2021. All indications are that inflation will continue to decelerate in the coming period. Markets. The first quarter was extremely positive, with all international markets recording significant gains. The major indices were up in the first quarter of 2023 and haven't retested the lows during that period. So the next question is, can the banking crisis of 2008 be repeated? According to JP Morgan, the answer is no, and there are three reasons for that. First, the supervisory authorities and all involved parties now have tools to resolve banking crises, and in addition to big banks are now much stronger. Second point is the economy is in a different level this time. Today, corporate and household liquidity is stronger than it was in 2008. Even today, debt repayment is showing no signs of concern. Third, today the problem was not caused by bad loans and complex investment products based on mortgage loans. So how did the markets perform during the first quarter? All the major indices moved up in the first quarter with the exception of Dow Jones, which fell marginally. The technology sector has been the winner with gains of almost 19%, while S&P 500 closed up almost 6%. The global stock index MSCI World moved up by 6.5%, while the European Euro Stoxx index rose by 13.4%. Bond indices moved slightly higher, as the very positive start of the year was curbed by an upward review of expected rate hikes by central banks.
Hello, I'm Demetris Theophanides, and I'm a Senior Private Wealth Manager at XSpot Wealth. Welcome to our market review for the first quarter of 2023. So, how did we get to the banking crisis? On March 10th, the banking crisis began. First, the American bank Silicon Valley went bankrupt, followed by the Signature Bank. The banking crisis was transferred within a week to Europe, and the historic Credit Suisse came under the control of UBS overnight to prevent a colossal domino effect of bank failures. Until a year ago, depositors did not have any investment option that offered them satisfactory return on bonds and money market products, as interests were very low. Following the recent implementation of high interest rates by Fed to fight inflation, the yields on bonds and money market products rose to attractive levels. Therefore, depositors and even banks chose to put funds there. With this move, however, some banks ran out of liquidity, and therefore they could not respond to the increased demands for withdrawals. So, are there any signs of optimism? Despite the recent volatility that dominates the markets, there are some signs of optimism for the future that investors should consider. Central banks currently provide unlimited liquidity to commercial and investment banks. Traditionally, this leads to a rally for stocks as investors consider the risk to be gone for good. The Economic Conditions Index is at high levels. Markets are moving lower, but because markets are forward-looking, they are likely to rise even before the Economic Conditions Indicator shows that all is well. Volatility, uncertainty, and fear are part of the investment process. They are part of the process that leads to significant growth in investors' wealth in the long term. Volatility is the cost that investors need to endure in the short term to see their wealth grow over the long term. So how did XSpot Wealth's model portfolios perform? Almost all XSpot Wealth model portfolios moved higher. The growth and growth ESG plans moved very close to the benchmarks, but with significantly lower volatility. In addition, our income and high income plans move satisfactorily and are excellently allocated according to the market conditions. Lastly, the Secure Plus plan, which is our most conservative plan since it invests in money market products, achieved remarkable returns of 0.47 in euros and 1.13% in dollars just for the first quarter, and we expect even higher returns in the second quarter due to the already increased interest rates. Our Secure Plus plan consists of money market exchange traded funds and has significant advantages over mutual funds in the same category and generates higher returns than market term deposits. Thank you for watching this series. For more information, please visit our website www.xspotwealth.com or scan the QR code to book your free consultation with one of our private wealth managers.